Hello, today is February 2nd and we're going to record some videos that cover a presentation we're doing in our office on February 8th. I mentioned the date here because there's a lot that can change between the 2nd and the 8th, so keep that in mind when we're going through this. But today we're going to cover retirement income in 2023. We're going to go over some of the things, the trends we saw last year, and what we expect to happen in 2023, which trends we expect to continue, and what things we expect to change. This series, for the purpose of videos, we're going to break it up into 3 separate videos. This first one, we're just going to go over Secure Act 2.0 and inflation. Next video will cover fixed income, and the final video will go over equity markets and close up by putting it all together. So without further ado, we're going to first cover Secure 2.0. And again, throughout this presentation, you're going to see some very random images. I promise that there's a reason for each of them. But again, you got to go to the last video to figure out what that is. So, Secure Act 2.0. This chart is a timeline of all the things that that changed when they rolled out some new legislation at the beginning of this year. If you remember, Secure 1.0 was rolled out a few years ago, and that was the legislation that moved required minimum distribution age from 70.5 to 72. Secure Act 2.0 expands on some of that initial legislation, and originally we were going to do a whole presentation on Secure Act 2.0, but the reality is there's a lot of stuff in here that's not going to apply to any of our clients, and so we thought it probably wouldn't be that helpful. So instead we're going to cover it really quickly and go over the highlights. I am not going to read everything that's on this page, but I will cover the important parts for our clients. Namely, as I move my face over here, RMDs are pushed back to age 73. So if you are born between 1951 and 1959, your new required minimum distribution age when you have to start taking money out of your IRA is now age 73. If you were born 1960 or later, your new RMD age, required minimum distribution age when you have to take money out of your IRA, is now 75 years old. This gives us a lot of planning opportunities for those that retire earlier. If you do not have to take money out of your IRA, this gives us an opportunity to do Roth conversions and move some money around to keep things as tax efficient as possible. So this change is going to have a significant impact on our retirement planning strategies. Another big change that again is effective 2023. 2024 is when they made a bunch of changes here. And again, I'm not going to read this whole list because for most of our clients it does not apply. If anything does apply, we're going to go over it with you specific to your situation. But the most interesting one is that 529 to Roth IRA transfers. This part has gotten a lot of press. There are a lot of gotchas in here, or we'll call them, things that make it less attractive than it seems initially. But if you have a 529 that's been open for at least 15 years, you can now roll the money into a Roth for the beneficiary, regardless of how much money they have, but the Roth contributions have to be made up to the annual Roth limits. So let's say that the limit is $6,500. You can't automatically move $35,000 into a Roth IRA for that person. They do have to have earned income, so you can't just go to a 15-year-old kid that has no income, put it all into a Roth IRA. But if the person was making $500,000 a year and was otherwise making too much to contribute to a Roth, there's no income restrictions on what can be rolled over. So you can still move money into a Roth IRA for that person as long as they're not making their own contributions. Again, very interesting planning opportunity here for people that were worried about funding 529s for fear that if the kid didn't go to school, that they were going to have no other option but to take a penalty to get this money out. This creates an interesting alternative that makes a lot of sense. So again, this legislation is very new. It came out, was passed at the beginning of this year. So a lot of these things roll out over the 2024 to 2028 time periods. So again, no immediate changes. If you're currently taking your RMD, you're going to continue taking your RMD. But we wanted you to be aware that these changes are now going to be in place and things that we're going to be talking to you about going forward. And that covers our entire conversation of 2.0. So again, if you want to know more about it, I'm happy to go over any of the provisions in there because there are a lot of different things. But for now, inflation. Again, the conversation we've been having, obviously last year was a very, very big year for inflation. It was historic in a lot of ways. It was a topic of most of our conversations. Where are we going in 2023? Obviously, the conversation has changed dramatically since the beginning of the year. And so I've just pulled a quote from BlackRock's most recent portfolio update. And I suppose I'll read it here. But the confidence to make these moves that they update in their portfolio stems from our belief that inflation has peaked and will likely decelerate at a sufficient pace over the coming months to convince the Fed, to pause, but for all practical purposes end, in our view, its rate hiking campaign. So essentially, they're saying that inflation is no longer going to be a problem. If this proves correct, it means the Fed's overly hawkish rhetoric and adverse influence on the markets may have also peaked. Softening U.S. inflation and less Fed hawkishness may also mean a peak in the strength of the U.S. dollar, which could make overseas assets particularly attractive on a tactical basis. So essentially, BlackRock's thought is that we are going to see another rate rise. We just saw the Fed raise rates by 25 basis points. There's a very real chance that we see another 25 basis rate hike in a couple months, at which point they will pause their rate raises. They will say that there's a chance they come back to it as they evaluate things. But the reality is, at that point, inflation should have come down sufficiently that they do not have to revisit rate raises beyond that time period. So this is where we are with interest rates at this point, and these lines here at the end represent the expectations that we have going forward. So right now we have this gray line is the Fed funds rate, and this blue line represents where the Fed placed their year-end estimates for themselves, where Fed fund rates would be. These green lines represent where the market expectations are. So again, we have here that the Fed thinks that they're going to have 5.1% short-term rates by year end of 2023. The market's thinking that they will be around 4.5. The Fed then projects that 25 and 26, that there is a relatively quick decline in the rates. The market thinks that that rate decline would be slightly faster. So that's what you're seeing priced in at this current time. Long run, you're seeing the Fed funds rate where they projected to get back down to 2.5. This has important implications for our portfolios because, again, when we looked at the pain of last year, and we'll talk about this when we start going over the bond slides, there was obviously a lot of pain with rates rising historically fast rates. We're not looking at that scenario anymore. We're not looking at a scenario where rates are projected to jump dramatically from here, which should give us some more stability going forward. Now, again, we go back to this previous chart. This is looking at what the Fed thinks on Fed funds rates. But here we're looking at what the market is actually priced in for inflation. Because again, if you own a 30-year bond, your biggest threat, your biggest concern is long-term inflation. If you own a 30-year bond and you're projecting here that you're buying it at a rate of 3.5 and long-term inflation happened to be 4, well, you're going to have negative 0.5% real returns for the next 30 years, which would be relatively devastating. So what the market's projecting here is that the 1-month rate's at 4.5. And again, this is as of January 18th. I'm talking on February 2nd, and the market has not changed much at this point, so I didn't update the slide yet. This could very well change between now and the 8th. But at this point, the 1 year or the 1 month's at 4.59. It's going up to 4.79 by the 6 month, and then it starts declining. And what this tells us is that in the 2 years at 4.6, the 5 years at 3.43. So this is telling us that the market expects rate to decline very, very quickly beyond this 1 year time period. That tells us that inflation should come down substantially, and we should expect lower rates going forward. So again, that's all I wanted to cover in this first video. The next slide, or the next video I should say, is going to go over the fixed income markets and where we see those going forward. Thanks, and look forward to talking to you more.